economy goes back into the recession, they've got to ease financial conditions again, comes right back down. And then when those loans were going to start adjusting, here we are back again in a low rate environment. We may not be able to sustain higher interest rates like this on a prolonged basis. And this may be a very fast cycle.
So you want to be a real estate investor, but where do you start? How do you know what information and sources to trust? That's where I come in. I'm Jonny Catani, and this is the Investor Relations Real Estate Podcast. Hey guys, real quick, before we start, go to investwithcatani.com and download my free ebook, Is Commercial Real Estate Recession Proof? Now to today's show. What's up, guys, and welcome to another episode of the Investor Relations Real Estate Podcast. I'm your host, Jonny Catani, and I'm joined today by Anthony Walker. Anthony is the CEO and managing broker of Buckingham Investments. Just as Buckingham Investments has been doing for over 50 years, Anthony seeks to be a trusted advisor and assist his clients with achieving financial independence and retirement security through investing in multifamily income property. He believes that real estate wealth is not created only at the time of purchase, but well before an investment is ever made through education and planning. He teaches frequent seminars on many aspects of investing and has been an invited guest speaker at multiple educational institutions and trade organizations throughout Southern California. Practicing the investment philosophy he teaches, Anthony has also developed an extensive portfolio of income property, the vast majority of which is located in the local greater South Bay of Los Angeles. Anthony, welcome to the show.
Thanks for having me. Happy to be here.
Absolutely. Very excited for today's conversation. Already off to a good start. We had a nice little off-camera convo. I had to go ahead and hit record there before we got too into the weeds. But take us back to the beginning here. You're not 50, or at least you don't look 50. So
not yet.
You're right. But Buckingham has been around for 50 years. So we'll kind of get to that. But take us to the very beginning. What were you doing before this, and what brought you to where you're at now?
Yeah, so I worked in the insurance industry for almost 10 years out of undergrad. I am a little older than I look, but I haven't been doing this for 50 years. And I didn't really want to stay in large corporations. So I went to go get my MBA at night and was trying to decide what kind of business I wanted to open. I wanted to work for myself. And I came across real estate investing through taking a commercial real estate course through the MBA program at Loyola Marymount, which was the school where I got the master's. And it was right there in the textbook. So I thought, hey, I don't need to learn how to code or invent something here. Maybe I'll buy buildings, and that'll be my business. And so through my network at school, actually, I got introduced to a company called Buckingham Investments. Right there. Now I run it. And I was a client first of the company. And this was, I think I met the company in 2009, 2010, and wanted to just get my investing portfolio started. I still had my corporate job at the time, W-2, and it was a pretty good time to get started. We were right in the middle of the subprime crisis. So values were actually continuing to fall kind of when I got into it. So I sort of caught the falling knife and started buying stuff around that time, 12, 13 years ago. Bought a little duplex to get my own portfolio started. And then a series of other properties with money that I had saved from year-end bonuses, tax, refunds and stuff like that. After a while, I thought, hey, maybe I could join the company as a broker. It's a brokerage company that specializes in helping our clients learn all about investing and get started if they haven't done it before. I really liked their model, very different from other brokerage companies. And so I got my real estate license, started doing it on the side, helping people buy properties, and ended up leaving my full-time job about 10 years ago now to transition to doing brokerage full-time. And then obviously with the complementary business of buying apartment buildings myself too in our local market. So I have this great kind of two businesses going along here that support each other really well. I'm a really active broker in our market here. And then I'm also now very active owner, buyer, and seller of apartment buildings, including doing some syndications. But most of the investing I've done has been just with my own capital from my active income business. So fast forward here now, 12, 13 years. I own about 15 buildings, personally about 150 units, mostly in the Long Beach market, but a little bit around here in Southern LA County, some other cities too. And it's been a lot of fun. I like to buy value add multifamily. It's a great market to participate in. I'm sure we can get into that. I do some syndications and stuff like that too. That's what we want to talk about. It's been a fun ride to be involved both at the brokerage level, building the company here, as well as buying stuff. We've got about 45 agents working here at the company now, and so we've been expanding and slowly moving our geographic footprint out as well.
Awesome. I love that. That's such a great story. And I love that the education piece, right? I love that component of it. And it sounds like, so since you're mostly buying, you mentioned you do a few syndications, but since you're mostly buying yourself, the education piece is helping people understand and teach them how to go to the active side, then I assume, right?
Most of our clients are looking to do direct ownership, or they're trying to figure out which one is right for them. So that's kind of a nice thing about our platform. We're a brokerage company first and foremost. So most of the people that come in the door are here to say, hey, I've read some stuff on Bigger Pockets. I've listened to some podcasts, whatever, right? I found your website. It looks like you guys help people make sense of this. And our typical client, it starts with us often as a buyer, maybe a seller if they already have like a single family they're renting and they want to exchange into a multifamily property. And yeah, we teach them all about how to directly invest in small apartment buildings, what the financing looks like, what to ask out of a property manager, what you have to do if you're going to manage it yourself, how to think about renovations, develop budgets, all the major systems, contract stuff. I mean, everything. And our platform is nicely set up in that we can give all of that education for free. Financial analysis, even people that have never taken finance before, we'll start them right at the beginning. And we do all that for free under the assumption that our broker's relationship is going to be with them. So we don't have to do things like charge for the weekend seminars. We're not selling books and stuff like, although we have books, but so it's really a nice business model, and it develops a lot of long-term trust-based relationships with our clients over time. We've had a lot of clients stay with us for decades as they build portfolios.
Wow, that's awesome. I love that so much. I'm a huge proponent of education first, right? And that's really how you're going to build, like you said, that network and have those sticky clients that just stick around, that just stay for life. And you're in an interesting market because not like we were kind of talking about off camera, not a lot of people, at least outwardly, involved in that market. So kind of talk about, what you've been seeing in your particular market that you're investing in, especially now as we're kind of seeing some economic changes.
Yeah, so it is a great market to be involved in. I know in the podcast and the seminar circuit, the hot states are right, the Sun Belt states, the Midwest, the South. We go to these conferences and we're like, hey, we're Southern California people, and they're like, what are you doing here? Nobody buys there, but it's actually not true. If you crack open CoStar, we're the second most traded market in the country, obviously, because we're a giant city, right? So there's a lot there. There's a lot of people here that are transacting, that are doing business here, and have managed, despite the odds, the legislative environment, that the tenant-friendly laws and all that kind of stuff, to do very well. And a lot of that boils down to just the benefits that you see here in the overall economy. We're the third most productive metropolitan economy in the world in the greater LA area. Our GMP is over $1 trillion a year. So we have amazing amount of resiliency in the rental market here, especially in the B and C type properties that we really focus on. The area stuff, the brand new stuff, is really the domain of super deep pocketed hedge funds and developers. We don't really do that because we're more focused on individual investors. But for the B and C properties, there's basically an unlimited supply of tenants for those buildings, no matter what you might read in the headlines or looking at the U-Haul charts or whatever. There's plenty of people in Los Angeles, probably not going to change anytime soon. Our vacancy rate is in the mid-2s right now.
Wow.
Yeah. So, you put something on the market, it's gone in a weekend, and the rents that you're inking on new contracts are way above what you estimated in your pro forma. So I know that's going on in the whole country right now. Inflation is a thing. Renter affordability is going to be a big issue, right, going forward. But things are going really well here. Cap rates at the time we're having this conversation is June 29th, 2022. Interest rates have risen in some corners of our market by 300 basis points since January. So it's a very new environment that we're dealing with. Cap rates have not really changed yet in our market, and I don't know if they're going to. We were getting into this a little bit, before we started recording here, but it's a really interesting question as to the direction of the market. We're working with a lot of clients right now trying to figure out what the right move is. There's a lot of people that are tempted to sit on the sidelines and thinking, well, with the rise in interest rates, cap rates have got to go up with it, right? I mean, cap rates for the stuff that we're doing here is generally like around 4%, maybe 4.5%, maybe 5% for the very highest cap rate type deals. Also not as low as you might expect if you're from another state.
That's really not terribly low.
No. Yeah.
Relatively speaking.
Relatively. I mean, you can go buy it too if you want to go to, the really nice parts of town. Like if you're going to go to Beverly Hills, maybe that's in the ones, right? Or Manhattan Beach or Santa Monica. If you're really in super nice areas, we have a huge spread on the risk spectrum here in town. But the stuff that's kind of in B and C markets, it's 3.5 with a lot of upside in the rents, or maybe it's 4.5 if there's not as much. But yeah, I mean, I've looked at other markets. I've had clients look at other markets, and for people that live here and know the area really well, it's like, well, the spread's not enough to really justify the cost of the plane ticket and developing a whole team in another area that you don't know. And if you've lived here for a long time, you have a major competitive advantage against other people, especially if you can understand kind of the local environment and rent controls, which is also not that bad in a lot of areas here. But it remains to be seen where things are going with the direction of rates. I think there's a lot of buyers thinking, oh, well, we're going to have another crash, right? Because that's what they're reading in the headlines. And most of the news outlets are talking single family, which has been a very different, more volatile story. Everyone remembers 2008 as the most recent recession we went through. So unless you were investing in 2001, which a lot of people weren't, that was over 20 years ago at this point, it's hard to remember what a garden variety recession looks like. And here in our local area, real estate values didn't even go down. They kept going up there. So it's definitely a battle, even internally. Do you wait and risk another 100 basis points on the interest rate in exchange for a 5% discount on the property price? And if that happens, if you do the math, you're actually paying more to buy the same property for less. So that doesn't make sense. Or, do you jump in and, lock your rate as low as you can right now for another 5 years? It's a tough one.
Yeah, absolutely. That is kind of the $1 million question, so to speak, right, that I know a lot of people are talking about. I know I've had guests that are fully committed. They're going to sit on the sidelines. I know some of the bigger institutions are sitting on the sidelines. Sounds like they have their eyes on like Q4. But it's so funny because, and listen, of course they have, teams of analysts with PhDs from MIT, and, they have a little bit more data than you and I may have, right, but trying to time things has never worked for anyone, And so if you're really sitting there trying to time it, it's usually a losing battle in some form or another, right? Interest rates go up. Okay. Prices came down, but interest rates went up, like you were saying. So what, let's come from two aspects here. As an investor, let's start from the investor standpoint. What, if anything, is changing in your investment strategy?
Yeah, I mean, that's probably a better question, right? I'm not going to be sitting on the sidelines, right? I mean, for my tax situation alone, I need to buy properties every year. So, real estate professional status, yay. But, looking at what's going on here, I think we need to obviously be cognizant of costs to renovate units. Labor and materials are a big thing. Interest rates are important. If anything, in years past, I've been the guy to want to do the most aggressive value add deal I could find, right? Because it looks so sexy. There's such a huge upside. Look at all that value I can create. Oh man, I just can't resist. I'm going to do it. 100% plus returns on equity, right, in a year. And looking at stuff now, it's like, wow, you're developing your renovation budget, and you've got a building that we have a lot of stuff that's 100 years old in our market, right? Where 1920s properties are very common, and it needs every major system in every unit. And that job used to take $200,000, and now that job takes $400,000 to $500,000, depending on the size of the building, right? Maybe you're talking like a 10 or a 12 unit building, 15, something like that. And so when you crunch the numbers there, and you look at what we're getting on rent increases naturally anyway, and locking in your cost of funds now and not going into bridge debt to make that happen, suddenly it's a much more sensible option to go buy the value add light, as we like to call it around the office, right? And these are properties that maybe have a 10 to 20% upside in rents. They're a little bit dated. Maybe they were done in the mid 2000s. Maybe they were done in 2015 even. And they've got finishes that are maybe just starting to go a little bit passe, but they're okay. And you can get away with doing the old, paint and carpet. Not that anybody uses carpet anymore, but lighter turns. You can get your longer term debt fixed on the purchase. Maybe you put a little bit of higher down payment down. You're not going and doing a 18-month balloon payment, bridge loan, wondering where the interest rate's going to be in 18 months. So my strategy there, I'm definitely now more inclined to look at deals like that. And I think, especially in an inflationary environment, let the market do the work for you. I mean, you're going to get incredible rent increases. Probably nobody's going to leave if they're 20% below market and we're at a 2% vacancy rate and it's expensive to move. You might get those rents for free if you're just a little bit patient. And we could still get commercial debt here in this area fixed in the mid fours for 5 years interest only, which is not bad at all. I mean, especially historically speaking, even looking pre-pandemic levels, we're kind of like back to normal right now. I'm sure it'll keep rising, but for those people that are wanting to participate, take advantage, and to your point, take advantage of just all the benefits of owning property over time, it makes a lot more sense to dive into that scenario than it does to roll the dice and either get super aggressive on a value add or plan on a large market downturn and hope that you're going to make some opportunistic buys in the near future.
Yeah, absolutely. You made a lot of really great points there. And certainly I think that the sentiment is changing around as well. Before you had, and it'll be interesting to see because you had so many, well, I should say so many, but you had operators who were willing to over leverage, right? Even the sophisticated ones willing to take on that extra leverage because they knew that, the interest rates were going to be in their favor, whereas that's no longer the case. And so you have a big shift in strategy. And so let's now look from the seller side, kind of the brokerage side. We know what buyers are thinking, right? What are sellers talking about now?
Sure. So yeah, I mean, this is kind of, I think, going to be the problem. I don't know if it's a problem depending on your mindset and your perspective, but this is, I think, what's going to stop our market from, or most markets really, from having like a major correction, right? If you think at it from the seller standpoint, and I would supposedly be a seller, right? I've got a lot of equity in my portfolio. If I did the math on my, return on equity projections for the next year, that would dictate I should be looking at exchanging a bunch of my properties, right? If I've got 50% equity or more, my return's been pretty far diluted. I could unlock a lot of that. I could exchange them into larger buildings. But from my standpoint now, I have buildings that are locked into like interest only debt at 2.75%, right? And what seller is that's a tough obstacle to get over conceptually if I'm thinking about selling that building, even if it's got 60% equity in it, and exchanging it into something larger at 5 or 4.75, right? That's just really hard to get my head around doing that transaction. And I'm certainly not in any distress on any of those buildings. And I think that's what we're seeing from a lot of sellers. There's obviously going to always be sellers that have life circumstances that dictate they need to sell, or there's sellers that, on syndicated deals where they're, everyone is sensing a market change and this is it right here. If you want to get it, go get it. Time to list fast now, and you're still going to get a great price. And there's not much on the market. There's still very low inventory. But I think moving forward, you always hear about this when you talk to brokers, is there's this disconnect between buyer expectations and seller expectations. So we spent the last 3 years in this red hot seller's market. Any seller expects, well, if you put my property on the market, I'm just going to add a few $100,000 for the heck of it. Somebody's going to come around and pay it. I'm probably going to get 5 to 10 offers. It's going to be great. I'm going to counter out everybody's contingencies, and I'm just going to walk away, like a bandit. And that's not the reality anymore. Buyers' expectations are, in the worst case, expecting a crash, in the best case, expecting to be able to negotiate a little bit and ask for repairs and credits on condition and really be focused on value and pay a fair actual cap rate. And we're talking about which tenants are paying. And so that disconnect makes it really difficult for transactions even to happen. On the sell side, you've got low inventory for all those reasons. You have sellers with low rate, relatively long-term debt locked in. There's no distress on the sell side. So that ship's not really turning right now. And then on the buy side, they feel like they should be getting a bargain in exchange for paying these higher interest rates. So, the broker in me is a little bit nervous about transaction volume over the next few years. Well, not few years, I should say next 2 quarters. But the investor in me is pretty happy looking at where things are going. And I think for, investors that get it and have that long-term focus, it's still a great time to be buying. I'm still buying stuff. Most of our agents are still buying stuff here. But it's really going to be an interesting late summer, Q3 and Q4 here in our market as well as I'm sure, many other markets around the country.
Yeah, absolutely. And one thing you said earlier was how even in the recession, you guys didn't really get hit that hard, and Utah didn't really either, relatively speaking. I think it was only like a 6 or 8% at its peak in terms of the dip, as opposed to obviously some places saw like, 30, 50%. So it'll be really interesting to see where the give comes from, right? Because something has to give somewhere. Either the buyers have to be like, okay, fine, or the sellers have to be like, okay, fine, I'll take a little bit less, so it'll be interesting. And we were even talking offline about how much capital is just kind of sitting and waiting. And so as soon as that opportunity comes, it's immediately going to be propped right back up. So it will be fascinating to watch for sure. And is there anything else you're kind of keeping an eye on aside from interest rates?
I mean, inventory is a great, leading indicator to look at in general in any market. If you're going to get changes to pricing, you're going to get inventory first before seller expectations start to turn, right? If buyers have more options, it's that supply and demand equation, right? So we're watching that very carefully as a potential, bellwether for maybe 3 months from now, what would happen. I can tell you statistics so far, they have inventory is still super low. It really has not gone up in our market at all. I don't think that's likely to change. I'm watching rents. Rents are still rising, ridiculously fast. I think I mentioned this earlier, but we do have to keep an eye on renter affordability here. I mean, your average in a lot of the areas that we're looking at, average 1 bedrooms are now $1,600, a 2 bedrooms $2,000, and these are not in like really nice area. That would have gotten you that unit type at like a beach town, before. Where now, yeah, you're a little further inland and, maybe not as nice. So at some point that, the consumer is going to feel it enough that is going to just stop the renters from being able to afford that. So I think we have to watch that and see where that goes. But as long as that rent growth continues, you could easily have flat cap rates and have prices continue to rise, right? And so a lot of people, I think, are comfortable with that as an owner, especially if you're buying, building with a little bit below market rents from where you are today. But yeah, it's going to be weird. I mean, I mentioned this earlier, but I don't see any distress. There's no foreclosures. I mean, you could say you could watch for foreclosures, but they're not coming, I don't think. I suppose, worst case scenario, a lot of these commercial portfolio loans that we do in our market, we have less agency debt on these smaller deals in LA because it's very competitive. Those loans usually have resets in 3 or 5 years. So if we're really going to have a big change and this goes on, to be a protracted period of higher interest rates, when you start to get those resets is when we might start to see pricing really adjust, right? Because then you've got sellers that, my rate went from 3.25 to 5 or 6. Depending on where we land. And now I really have to make a decision about something. But that's a long ways off. I mean, we were just inking those new loans 6 months ago. So, it might be a really long wait before any changes. And to your point about the capital on the sidelines, raising interest rates affects the demand side of the equation and pulls the capital out of the market and it puts it on the sidelines. Some of that's evaporated in the stock market, right? But
yeah, for sure.
Raising interest rates doesn't really affect the supply side of the equation. And you hear that in other contexts, other parts of the economy too, all the supply chain issues and, the war in Ukraine and all that kind of stuff. But, Federal Reserve policy can only go so far. Yeah, it's affected the demand side, but as long as the supply side stays low, what's really going to happen? I don't, like we were talking about, I think this is going to look more like 2001 than 2008. I don't see the systemic risks. At some point, things have got to change because, you got to put 45, 50% down to make something pencil right now. That's just tough. But I don't know where it's going to come from.
Yeah, it will be very, very fascinating to watch. And I've had conversations like this where really what's happening is we're just in a new place. We've never seen anything like this, right? Inflation's, at least in our lifetime, the highest it's ever been.
Right.
And you just have different variables at play now that haven't been at play before, right? Supply chain issues. I don't think we've seen that before, due to the pandemic. And like you said, some of these deals were inked just 6 months ago. You even think about the ones that, happened during right in the heart of the pandemic when interest rates were first very low. We're only 2 years into those.
Right.
Those may be they're probably more like 5-year arms anyway. So
right.
It's it's a slow, kind of arduous, kind of almost like ticking time bomb, but it's not really going to be that big of an explosion, I don't think.
Well, and I think, there's a very real possibility that we tip into recession, right, in the later part of this year. Maybe beginning 2023. I mean, a lot of people think that's a likely outcome. And if that happens, I mean, for the property market, it's a slow enough moving boat. We may basically kind of dodge the majority of the damage that would happen, right? If interest rates rise fast enough, economy goes back into the recession, they've got to ease financial conditions again, comes right back down. And then when those loans were going to start adjusting, here we are back again in a low rate environment. We may not be able to sustain higher interest rates like this on a prolonged basis. And this may be a very fast cycle. And if that happens, I think values are just going to look like this while people figure out what the heck is happening with financing. And we may look back on this and be like, well, where did that go? Where were the deals? they never came. I think that's a very likely outcome, actually.
Yeah, absolutely. And one thing that could actually happen is you could see capital leave this alternative asset and go to where, like for instance, the stock market, crypto, things like that, where, I'm in the stock market. I think everyone is in some degree, or crypto in some degree, and a lot of opportunity there right now, so you could see a lot of capital leave this as they're kind of sitting on the sidelines, so to speak. And so it'll be very, very interesting to watch. It's always fascinating getting different perspectives, but it all seems to kind of equal the same sentiment where we don't know, but it doesn't feel like anything major is really coming.
Yeah, and so as a buyer, it's like, well, shucks, it's just not going to happen. But it makes it difficult to just do business, right? I mean, you're going to have to, and I think this is the same focus you hear on, there's a lot of business radio shows, whatever, about, even buying companies, or stocks, is a focus on value becomes much more important in this environment, right? If your cost of funds is super high, you've got to make sure that what you're buying has got a solid income stream, that you have the ability to add value where you can, your ability to well manage properties and get good rents and keep, renovation budgets under control, and all those things becomes that much more important when everyone's margins are going to be squeezed for a while here. And there's a lot of people that I think have done really well over the last 10 years, just by virtue of the direction of the market. And so it's going to be a more difficult time period just to be an owner for a while, and to be an investor if you're looking to buy. You got to be careful, but there's deals that are going to happen. There's good deals out there. There's always a reason for somebody to sell, and we'll work it out. Like you said earlier, trying to time the real estate market is a fool's errand. I don't care how well educated you are, or what statistics you have. Nobody really knows the future. What we do know is that, you look back 100 years and people have done really well owning real estate for the
Yep.
long run, and they probably will continue to do so.
Absolutely. It's a get rich slow scheme, right? And I think
Totally.
a lot of people, especially my generation, the millennials, are very much like, oh, crypto's way, like I want to get rich,
Right.
and instead of building wealth right now feels like that opportunity where it's like, okay, now I'm going to get rich because stock market's down, crypto's down.
Right.
And that's great, but that's not going to equal wealth and cash flow and the things that truly,
It's the wrong mentality to take to real estate. Actually, the Wi-Fi password at our office is get rich slow. So I love that you threw that in there because that's our business.
That's amazing.
But if you unpack the long line statistics on this, it's way more effective to just participate and let your money do its thing. If you're young, I know that like emotionally and conceptually, you have the drive to do the get rich quick thing. That's like just what you want. Everybody, they want the crypto, they want the GameStop, they want to do it overnight. And where's my Lamborghini? But the reality is your single biggest asset if you're young is time. If you're young and you don't understand the time value of money equation and how powerful it is to still be in your 20s, if you're in your 20s, you don't understand the millions of dollars you're leaving on the sidelines by not investing in a long-term asset and letting your capital work for you, especially in an inflationary environment. If the dollar's eroding at 8.5% annually, and you can still borrow at 4.75, that's not a high interest rate. You're actually still getting paid money to borrow those funds. If it's eroding at 8.5% in your bank account, go do the deal. People are just not focused on the right thing, in my opinion.
Yeah, I couldn't agree more. But it's nice now. It gives an opportunity to educate and hopefully help a few people understand. And I've had young people on who already get it at 23 years old, and I'm like, man, I wish I would have got it at 23 years old.
Yeah, me too.
But I was trying to get rich fast. So, did a lot of dumb stuff, but, no regrets. Right. Still got plenty of time. I'm only 31. So I'm
10 years ahead of you. You're good. You're where I was when I was just beginning. So I didn't have a podcast when I was 31.
Yeah. Well, 10 years ago that, I think podcasts were just barely becoming.
Yeah, it was hard to do that at all. Yeah.
Absolutely. Awesome. Well, as we wind down here, we'll jump to the final 5. I got 5 questions I asked all the guests. Sure. First question, best advice you've gotten from a mentor?
That's a good one. I've got to give it to Marty Stone, one of the founders of our company. He's been investing since the 1970s.
Holy cow.
Yeah, amazing. And
if he can do it at an 18% interest rate, you can do it at a 4.75% interest rate.
And he says the most hilarious things. We had him on one of our seminars a couple months ago, and that's the topic was investing in an inflationary environment. And his answer was, I don't know what you guys are talking about. We were doing all kinds of deals at 18% in the 70s and 80s, and we made a ton of money. And I don't know if he remembers the specifics of because there wasn't a lot of specifics in his answer. But I think the more important thing to that bit of advice is there's a way to make money in any market. If you're terrified of where it's going, the market is going to find a way to do business. You're going to find a way to operate in that environment. And if he can do it in the 70s at 18%, you sure as heck can do it at 6%.
Absolutely. Yeah. You said something earlier where you talked about people who've enjoyed, kind of the market doing all the work for the last 10 years. That's the only place I see any distress coming are these groups that don't have the fundamentals to shift their strategy and actually have to implement like an actual business strategy and not just be like, yeah, the market's going to do it all. So could be some there for sure.
Maybe you'll see a couple opportunistic deals come out of those operators that need to cut and run. And hopefully they bought a few years ago and they've done well. And, they're just struggling with operations right now. But I agree. Yeah, you got to be careful with, who you're investing and make sure that they've got experience and they've been doing it for a while and all those things.
Absolutely. Awesome. Next question. What is it about your career that makes you feel like you're fulfilling your why?
I love helping people. That's what brought me to this company originally. When I was signing up here, I was about your age, in fact. And by then I had a corporate job for almost 10 years. I didn't want to do the suit and tie and cold calls all day long to get into brokerage. And I wanted to find a different method. And so that's what really spoke to me about Buckingham's business model. Is our whole focus is on helping people understand how investing works. Our original founder, Jack Buckingham, believed that if people understood how investing worked, everyone would invest. So he created the company to help people understand. And that just spoke to me so much. And so that's what keeps me coming into the office every day. I love helping people. My favorite meeting is with a brand new investor, and I can see their eyes go wide, who've never taken a finance class before, right? And suddenly understand like how this works and how powerful it could be for your life and your family and your goals. I love that stuff. So that's what keeps me coming in.
Absolutely. I love when people learn about two things. One, I love teaching them about bonus depreciation and the tax incentives, and two, compounding. When they see that like money doubles every 7 years at a 10% rate, they're like, wait, what? Whoa. And you're like, yeah, exactly.
Right.
Favorite non-real estate or investment related book?
Ooh, good question. I'm a sci-fi guy. That's my stuff. I've got to do the obvious sci-fi answer and go with the original Dune.
Nice.
I read that when I was young, and the vision for that world was so cool.
Yeah, I can only imagine back then what that envision in your head looked like.
I think it was written in the 60s originally, right? And so much of that is the basis for basically all science fiction since then. It's all pretty much a rip off of Frank Herbert, and then a surprising amount of that stuff has sort of come to light too. So really cool.
That's awesome. If you could have any superpower, what would it be?
Ooh, that's a dangerous one. Oh man, I don't know. I think it would be great to fly.
Yeah.
Just feel that. It'd be so cool.
That's mine.
Something benign. I don't need to like teleport or live forever, or anything violent, but just to feel the fly would be pretty cool.
I get why the answer is teleportation, right? You want to be there instantly, but I think that actually being able to fly would be so cool. Like I would enjoy being awesome. Like, it's going to take me some time to get there, but I'm literally flying. So
how fun is that? Totally.
Exactly. 1,000%. Yeah. Awesome. Last one. What's the best way for people to get a hold of you and learn more?
People can check out our website, buckinghaminvestments.com. We have tons and tons and tons of free educational materials and primary research we do in our own market. We have a whole research dashboard of statistics that you can't find anywhere else. We do our own research. Sorry, it's only Southern LA County right now, but we'll expand it soon. If you want to shoot me an email, I'm at anthony.walker@buckinghaminvestments.com. You can probably find me on LinkedIn as well, and would love to hear from people.
Awesome. Anthony, this has been incredible. Thank you so much for joining and for sharing all your insight.
Absolutely. Thanks for having me today.
Yeah. Hey guys, thank you so much for watching today's episode. I hope you really enjoyed it. Listen, I know it's cliche and you hear it all the time, but please don't forget to like and subscribe to the channel so you know when the next video is coming out. Even though this is technically a daily podcast, you know it's coming out the next day. We have a ton of content coming your way. So please like and subscribe. It helps a ton. Leave comments. Would love to know what you guys think. And we will see you on the next one. Thanks so much.